Nomi, thank you very much for joining us today. How are things in Los Angeles?
Thank you for having me on, Jimmy. Things are good. They're actually quiet for a bit in LA.
So I always hear how expensive the gas price is in California. How much are you paying in LA?
We are paying about $5 a gallon, Jimmy, if you can believe it. I think that is the most expensive gas in the United States.
That is crazy. So I'm based in Toronto. We're paying $1.35 Canadian for a liter. The equivalent is around 375 in USD. So
Well,
I can't believe we're actually paying less here for gas than you are in the state of California.
yeah, California gas is definitely up there and creeping up, even though oil prices are down, actually.
Yeah, that is crazy. So I want to start a conversation on something that you know very well, and that is the Fed. And we recently had a Fed meeting. So I want to get your comments on Jerome Powell and what he had to say. And he said he and the rest of the Fed is still very focused on their dual mandate of low inflation and maximum employment. He also went on to say that tariffs will drive inflation up, economic activity lower, and he also said eventually the unemployment rate's going to go higher. He did say the risk of higher unemployment has risen, but it hasn't materialized yet. And it's shocking to see that the unemployment rate is still hanging around this 4.1 to 4.2 percent level. But what are your takeaways on what Powell had to say?
Well, interestingly, what he said this FOMC meeting was pretty much what he said the last one. So it's almost like kind of a groundhog FOMC Powell day. Because what he's also grappling with is that the GDP numbers, the economic figures, whether it's consumer confidence, GDP being down by a third of a percent for the first quarter of 2025, um, he has to kind of ultimately get around the idea, or at least you sort of embody the idea of economic slowdown versus this trying to stick some arbitrary inflation number. And I say arbitrary because whether inflation is 2, 2.4, 2.8, 1.9, I mean, we're basically talking about a whole lot of numbers that go into that aggregate inflation number, whether you're looking at PPI or CPI X core, whatever it might be, that the Fed is looking at, and the Fed doesn't really have the ability to control inflation to such a narrow degree any more than they can control, for example, gas prices in California, right? All of these things come into play when you look at calculating numbers. And so what he basically said was nothing. He basically said we don't really know if we can do anything at this moment, so therefore we won't. We still have a situation where they're effectively flat in terms of quantitative easing versus quantitative tightening, meaning they're still letting $5 billion, which is basically nothing, of treasuries roll off each month. That's down from 25 billion to FOMC meetings ago, but effectively they're keeping things very, very status quo. And I think the Fed is hoping that somewhere along the line, inflation is going to go down to like 1.999 for, a couple of prints. The job market's going to stay around the 4.1, 4.2 area, and tariffs won't necessarily move inflation up by that much more. It's interesting that tariffs, or the expectation of tariffs, has not actually moved up the most recent prints of inflation by more, because what we saw last tariff go around was that prices actually preceded some of the tariffs coming through on the expectation that producers and manufacturers and store owners and so forth would be in the future paying higher prices. And we haven't really seen that too much this time.
So what's your take on the economy? Because we have a lot of mixed messages. When we look at the non-farms that came out for the month of April, the number was a lot stronger than what the market was anticipating. But then when you look at the GDP number that you just referenced for the Q1 number, was a lot weaker. A lot of that had to do with net imports surging 41.3%, the largest jump since 1969. People just trying to get ahead of the tariffs. But what's your sense on the US economy here?
Well, I think in general, yes, yes, definitely imports physically went higher, and that was part of trying to get in materials in particular and supply before tariffs might come into play, and so that definitely had an impact on this sort of equation between exports and imports as part of GDP. But also there has been less capital investment. Business investment has been down by multiple quarters at this point. Consumer confidence is also down to levels that we had just seen basically in 2020, July 2020, in terms of COVID periods, where there was just like rampant uncertainty as to what was going to happen. And part of that is that uncertainty kind of, is its own momentum force. Uncertainty begets uncertainty until there is certainty, and then a lot of that can wane back down. But we're not out of the woods yet in terms of the expectation of where tariffs could go. We're still in this like 90-day period of, sort of post-Liberation Day, 90-day kind of, we're waiting to see what gets negotiated trade agreement-wise. There just was today an agreement between the UK and the US, which was pretty much expected. The UK has really been playing a role of being a friend to the European community as well as to the United States, and trying to really not have to deal with egregious tariffs on their own products into the United States, and that's kind of manifesting. But still, the uncertainty is there, and ultimately, I think that means we're going to have another quarter of pretty much anemic economic growth, whether that's slightly negative or slightly positive, until we have some more certainty as to where this could go. And of course, if it goes really wrong, and something happens whereby these agreements don't come into fruition, or most of them don't, and we go back to, the April 2nd announcement of tariffs being, sort of a multiple of trade deficits, well, then we could see things get a lot worse. I don't think that's going to happen, but I think that's still a possibility that the market is contending with, the economy is contending with.
And do you see the US economy going into a recession?
Well, again, we if we have another negative quarter of contracting growth, and effectively that is a technical recession. Right now, we're pretty much flat, a little bit negative on this quarter. If we adjust for inflation, even though it's back around the sort of on average 2.2, 2.4 per annum right now, and we'll see what happens as tariffs get ironed out or don't. We might see another quarter again like this. We might see another contracting quarter, or flat-ish, or flat adjusted for inflation, and that's a technical recession. And so from a mathematical standpoint, yes, but that said, our economy is pretty complex. And so if we look at certain sectors, the energy sector, some of the commodity sectors, some of the manufacturing sectors that are necessary for defense, and in certain other subsectors, we actually see growth. So it really, it really depends. Overall, we could see a flat, maybe minor recession economy, but also we're going to see sectors that are still showing growth.
And Powell is concerned about higher inflation and lower growth,
Right.
which is really stagflation. Do you see the threat of stagflation happening?
Yeah, and that is mathematically what we have, right? We do have contracting to slow growth. We have negative growth if we adjust for inflation, which means that inflation is still outpacing growth. And if we do continue to have inflation up between the 2 and 3% on annum level, or even if we go slightly above 3%, then when we are in a technical stagflation. And so he did suggest that was a concern, but it's not enough of a concern yet for the Fed to turn around. I think if that continues for longer, and we are predicting 100 basis points of easing for this year, which I think at this point the market is as well. We said this last December at Print Sites, we were anticipating 100 basis points, even though the Fed was saying 50, because we did expect the economy to slow down relative to inflation. On the basis of uncertainty on tariffs, on just where we're at in the economic cycle, and the fact that the Fed, no matter what it says, does, pretends, thinks about, talks about, actually cannot control, the factors that contribute to real inflation.
So let's talk about the consumer now. And the consumer drives 70% of the US economy. And we've seen so many signs of weakness with the consumer. McDonald's, Wendy's, and Starbucks have all reported lower foot traffic, lower revenues. They've all said same-store sales were down quarter over quarter, year over year. And the last time we spoke, you expressed a lot of concern about the consumer. What are your thoughts now?
Yeah, I think what we talked about is manifesting in sort of the middle and lower income levels. When you talk about McDonald's having a negative quarter, which it also hasn't had since COVID, and at that time, they were closed. Right now, you're talking about fully functional McDonald's franchises in terms of they might have slightly less of a footprint, but for the most part, they're all open. So it's basically a worse figure to have a 3.1% down quarter on sales relative to even COVID, even though we're comparing it to COVID, because then again, things were close. And Starbucks, which is, slightly above sort of lower middle income in terms of people paying, $5 or $6 for, a specialty coffee. That's a slightly different bracket. But these are signs that the consumer is saying, look, I don't really need that. I can get, I can take a cup of coffee from home. I can get, less at McDonald's or not go to McDonald's on my way to somewhere. And those little micro decisions ultimately come into play with these lower consumer figures, but they're also reflective of where the consumer is at in terms of debt. We talked about this. The consumer is still facing record debt and worse, record interest payments on their debt, because even though rates have come down a little bit, since their sort of periodic highs, 100 basis points last year, none so far this year. On a credit card basis, which is consumers have been placing more basic needs on their credit cards, food, gas, utilities, even rent, that's a harder pill to swallow. So we're also seeing them say, look, if we have to pay our monthly payments versus, going to even these like lower priced um, restaurants or food stops or whatever they might be, then we're going to have to do that first. But even so, we're seeing more delinquencies coming into credit cards. And so there is a debt problem that is marrying up with that uncertainty as to what are things going to cost tomorrow. And I'm just going to batten down the hatches today, which is what we're seeing manifest from when we talked about it to now. We're just seeing more of the numbers come out. And I think that's going to continue.
Louis Vuitton also came out with lower than expected numbers, both in the US and China, their two largest markets. So it was interesting to see it's just not the middle class that are struggling, but also the rich are cutting back on their expenditures.
What's funny about the gym? I was out in Colorado recently at a mine site visit, and I needed a sort of warmer clothing for the night. Anyway, I went into Neiman Marcus, which happened to have been next to my hotel, which was just where it was, and there was this designer coat, which I kid you not was originally priced at $11,000, and it was on sale at $8,000, and I'm thinking, who exactly is even doing that? And I asked the store person at the storefront there, and they were like, yeah, no one's buying any of this stuff. These are just random prices and random merchandise, and the merchandise is going back. So yes, it is. You are seeing that at different levels of the economy as well.
So as I mentioned, I'm based in Toronto, and our real estate market here has been off the charts here in recent years, but it's finally starting to come undone. Home sales in Toronto plunged 23% year over year. Listings are up 54% year over year. So um, I know we're definitely seeing a slowdown here in the Canadian economy. We haven't seen any egregious numbers yet on the negative side, but I think it's coming.
Yeah, and here too, you're seeing a lot more supply come onto the market and not move on all levels of home sales, particularly existing home sales, and new home sales aren't moving because they're basically not completing because existing home sales are starting to really wane. And so we're seeing that here as well. And part of one driver for that is the fact that rates in the longer end of the curve, aside from the uncertainty of the economy and the debt overhang that everyone has, rates really haven't come down in the long end, which is another indication of the uncertainty that's out there in the yield curve. So even when we've had that 100 basis point cut in the front end, we haven't seen that come into play in the 10-year, which is, basically where mortgages are priced from. So there's a lot of, we talked about stagflation, there's a lot of stagnation, as a result in the housing market.
So I live in Toronto, which is in the province of Ontario. It's a population of 15 million people. Our unemployment rate is 7.5%, believe it or not. That's a 10-year high. And I'm surprised the unemployment rate in the US is so low, hanging in around 4.1 to 4.2%. Are you surprised? And do you see it going significantly higher here in the coming quarters?
Yeah, I actually am surprised that we've had it stick that much so because, well, first of all, we know a lot of government jobs have been deleted, but then they were sort of rehired. So it might be, depending on where that goes, that could funnel into the economy. And there's been a real slowdown, in terms of hiring because there's been a slowdown in capital expenditures of companies because They don't know what's going to happen in terms of the economy, in terms of tariffs, in terms of the market, and in terms of where the Fed will go. So that's why hiring has sort of slowed. So it is surprising that the actual number has stayed as a percentage where it is. And it also calls into question a bit of how these numbers are actually calculated in terms of how long someone's been in a position where they're looking. If they don't look, they don't get counted in the percentage. So in other words, they've been looking for a while and they don't find a job and they stop looking. They're not counted as an unemployed person. They just sort of fall off of the math. And this has always been an issue, but it's more apparent when you see this difference between the number and what you think is going on in the economy in terms of what's really going on.
So let's look at the S&P now. And of course, this is what everybody's concerned about, especially if you have a lot of investment dollars there. But just to recap, the S&P topped out in February at 6,100. It went all the way down to 4,900 on a correction. That was a decrease of 20%. Now it's had a massive rally off those lows. It's essentially up another 18 to 20%, trading around, let's just call it 5,800. Paul Tudor Jones, he did an interview recently. He expressed a lot of concern about the S&P. He said he sees it going significantly lower just on an earnings contraction. And he also said because of the headwinds associated with what's happening with China. And what's your take on the S&P? Where do you see it going?
Yeah, so even though we've been talking about a contraction or possible, stagnation, stagflation with respect to the economy, I think this rally in the S&P is partially due to the expectation that even though it didn't happen this time, the Fed's ultimately going to pivot to help the economy, to help the low growth, to get over the sort of inflation idea, and that the inflation numbers are as high as they're going to be, or more or less as high as they're going to be for the near term. And when we do have lower rates, obviously that's going to help to fuel, the growth, the tech sector and everything else. And so the market's kind of ahead of itself in that. And that's also what we've seen in Fed funds futures going from, a very low sort of 20% in the very beginning of the year expectation of a 75 to 100 basis points cut to now a 68 to 70% expectation of that for this year. So the market's really involved in thinking that cheap money or potentially quantitative easing to help the economy is going to come. And I agree with that. And as a result, I also think that the market's not going to take a dive. It's going to be volatile. There's just still going to be movement that happens when there's a negative announcement in tariffs or negative earnings versus a positive one. But to the extent that we get livable agreements, or at least certain agreements with respect to tariffs in this 90-day period, I think the market's pretty comfortable where it is and would have upside, if the economy stays low and the Fed cuts rates. So I actually look at the S&P as ending the year higher than it is right now versus lower. I think we're going to see volatile periods, but a lot of the real knee-jerk reactions to tariffs, again, unless they go really badly and don't get any agreement signed, like the one that was just going on between the UK and US happen, that the slowing economy and the consumer and everything else we've just talked about is again going to push the Fed, and that's going to create lower rates, and that's going to create a sort of influx of cash that is on the outside of the markets that can be utilized for investments and is sort of waiting for the jump in moment to come back into the market. But there's sectors that are going to still, even in that scenario, do better than others. We've seen, for example, gold is just a commodity, has done super well during all of this period of uncertainty. It's done well. The markets have gone down. It's done well when the markets have come back up. And so you do have these investments which are showing that whatever happens in the equity market, there are components of it. Miners, for example, still need to catch up with gold prices, but there are components of it that will do well. And I think overall we're gonna be up from here end of the year on gold and on the S&P actually.
So you brought up gold. I'm sorry, do you have a view on gold? Do you see it going higher, or do you think it's going to pull back? It's been weak here in the last couple of weeks.
It's been weak. I mean, it came off that 3,500 level to 32 and change. Now it's back up to around 34. So I mean, it did pull back just under 34. So it did pull back. It went very quickly to 35 and a bit past 35. So I think that's fairly natural given how many different players are involved in the gold market. But ultimately, if you look at the factors that are driving gold, there are so many that actually support each other, from central bank purchasing to dollar diversification to uncertainty hedging to wealth preservation to now diversifying relative to the stock market, no matter what it does, which is kind of a new thing for gold. And also seeing a lot more ETF buying, certainly in Asia with respect to sort of more gold backed versus gold miner backed ETFs. A little bit less in the West, but we did have a record in Europe at the end of last quarter in terms of buying into those types of investments, gold ETFs. So I think all of these things are in play, and they're going to continue regardless of what happens with economic data. And if the Fed does ease, it's actually going to benefit gold prices by that much more as an additional factor. I'm not even counting that in when we're looking at where gold is now. So I see gold around 4,000 by the turn of the year and 5,000 by the turn of next year. And last summer I said it would be around 3,000 the turn of this year. So I'm consistent in terms of how I look at all the factors and how they're overlaying each other with respect to gold and from a geopolitical and international basis. So I do see it rising. Again, nothing's a straight line. Same with the S&P. I don't see it shooting up from here to like higher by the end of the year. It's going to be jagged moments. Same with gold, but gold will be higher, I believe, by the end of this year, by 400 or 500 dollars per ounce, and then another 1,000 or so by next year, if everything continues in the world in terms of, again, diversification, central bank buying, tier one diversification for assets at central banks, wealth accumulation, ETFs, more private wealth coming into the gold market because it did so well during the volatility. And all these factors aren't necessarily, they're not going to go away. There's no real counter factor here.
You mentioned earlier that you think the Fed's going to cut by 100 basis points this year. We have another meeting coming up in June. Do you think they cut then?
I think they do cut then. Whether they cut 25 or 50 then, I'm still not sure. I would think he toes in at 25, and I think it would be to accommodate that we had, sort of negative print on GDP. There's a low print or a low expectation coming in from Atlanta Fed now, which is the Fed's sort of ongoing calculation of where the economy actually is. They're generally fairly accurate. And if you look at that figure, it's right now about 1.8, 1.9, but that goes much lower. Again, that's stagflation. So I think going back to what we were saying before, with Powell being sort of not really saying anything new this time, to me, that was an opening for him to see what's going to happen with respect to growth versus them wanting to stick inflation. And with growth slowing down by more than inflation rises, I think we see that cut. I would expect 25 the next meeting, though, just because that would be consistent unless we get like a really bad print, which we don't have a GDP, we don't have a quarterly print coming in these two in between now and the next Fed meeting. So I would expect that print to happen before a 50 basis point cut would occur. So if we get anything, it's just 25 to sort of like finesse the edges.
I want to ask you about this relationship between the president and the Fed, or the chair of the Fed. And you wrote a book in 2014 called The President's Bankers, and it provided an overview of this relationship between past presidents and also Wall Street bankers and also the Fed.
Right.
And I'm curious, from a historical point of view, have you ever seen anything like what we're seeing right now, where the president openly criticizes the chair of the Fed, calling him a loser or a fool or
Yeah, no, I mean, there's no real historical precedent for that. Of course, we didn't have social media during most of the period. That book encompassed to the late 1800s through the Obama administration when it came out. And what's happening now, and it's interesting because, of course, President Trump did appoint Jerome Powell to be the chair of the Fed during his first term. He was basically number two seat behind Janet Yellen at the time, and proceeded in 2018 to want him to cut rates more quickly than he was. And it took about a year before Powell did in fact cut rates in 2019, and not necessarily because of what President Trump was saying openly, but also because there were some problems that were coming with Wall Street banks. There were liquidity issues, there were repo issues, there were a lot of things going on. And then of course COVID happened, and yeah, there was massive cutting, and there was no question. And now we're back into a scenario where Powell was saying kind of same things he was saying in 2018 about tariffs causing inflation, and we need to kind of be vigilant. But if and President Trump is basically saying similar things to what he said back then about Powell, though he actually backed off of some of the recent comments with respect to how Powell's handling rates, saying, okay, well, he can kind of, he was first saying he's kind of couldn't wait till he wasn't in that position, and now he's kind of backed off from that, President Trump. So, which is similar to what happened last time. So I think that's why Powell will ultimately cut rates, but not exactly when his name is out in social media with respect to the White House, which is what he did last time. But fully no, this is a unique kind of historical interchange between the public nature of the comments about the Fed from the White House.
And Jerome Powell's term ends, I believe it's in May of 2026.
Yeah, he's
Do you
got
have
time.
any thought, or as chair anyway, but do you have any thoughts on who will replace Jay Powell?
I don't at this time, to be honest. There's it will very much depend, and I can actually see Powell potentially, being there. So it really does depend a lot on what happens over the next year or so.
Do you think the Fed survives in its current form?
Um, that's a very interesting question. I think it stays in its current form because it takes an act of Congress to actually change the makeup of the Fed. And given how uh, slow Congress is to move on things it doesn't have to move on, relative to even things it does have to move on, the idea of passing an act, or even a congressperson or senator bringing up a bipartisan act, which is what it would need in terms of numbers to change the makeup of the Fed, is very unlikely. Um, that said, I still believe that the Fed in its current form doesn't have the capabilities it thinks it has, i.e., controlling inflation, controlling the job market, and a lot of what it's doing is incidental to what's happening anyway in the economy, with jobs, with tariffs, with inflation, with supply chains.
So I want to get your views on how the current administration has done in the first 100 days. And there's been a lot of criticism on how they've handled the whole tariff situation. And even many of the president's supporters, Bill Ackman, come to mind, and also Ken Griffin. Ken Griffin, who's a staunch Republican, has donated over $100 million of his own money toward various Republican super PACs. But how do you think the president has done in the first 100 days?
Well, I think he's created a lot of uncertainty, and it's very difficult for corporations and for individuals to make decisions with that sort of veil. And it's not just uncertainty with respect to what's going to happen, for example, with terrorists, but the nature of how it's unfolding. And that instability has been a drag on economic decisions. So I think that's been a negative on these 100 days. I think that also it's not clear that there have been executive orders that have been very positive also in terms of what the administration wants to do with respect to supply chains, U.S. domestic supply from critical minerals through energy minerals and so forth, and having processing capabilities in the U.S. versus China, and sort of trying to sort of bring home manufacturing and all of that. However, there hasn't been a lot of actions behind those orders yet. And so I think from that standpoint, the 100 days aren't really enough to get a sense for how much more this administration is going to push activities and funding of the policies that could be useful for the economics of the United States and national security to move forward. So that remains to be seen.
So one industry that's really gotten hit hard on the back of tariffs and all the uncertainty associated with them is the auto industry. Ford has suspended guidance for 2025. They said they're going to take a $2.5 billion hit. GM also has a large exposure toward the tariffs. They're going to take a $4 to $5 billion hit. We have numerous auto plants here in Southern Ontario. GM just laid off 750 employees from one plant just outside of Toronto. Any thoughts on what's going to happen with the auto industry?
Yeah, I mean, those are all signs of this, massive uncertainty with respect to tariffs and where policy has really, and the communication of policy and even decisiveness on it has really failed the auto industry as of this moment, because it is such a global industry. There's no such thing as the U.S. auto industry. I mean, even if U.S. consumers buy US cars. I mean, that car has been built and the pieces in it have been built on a global supply chain, and workers have been hired on the basis of global supply chains into a car. And so when you don't have the certainty as to how much each piece is going to cost, or where workers need to be in order to reduce the cost of certain, pieces that are needed for a car, or what steel is going to cost, or what aluminum is going to cost, so the basic commodities that even go into physically constructing a car, let alone the semiconductors and the technology that operate the car. It is a real problem. What Ford's saying, what the companies are saying, GM, is that we don't know the numbers that we're working with, and that's a really difficult spot to be in. And that's a negative on the auto industry, not just in the United States, but over the whole entire supply chain. Because you don't change manufacturing and workers and supply chains and where products are, starting from and ending in a quarter. But what you do in a quarter is have the inability to make decisions as to what's going to happen next. And what Ford was basically communicating, aside of what loss they might have to take, is that we don't actually know what to do because we don't have the information that we need to make those decisions is not decided yet. It's not communicated yet. That's, going back to the 100 days in the tariff situation, that uncertainty funnels through the top level of the auto sector by almost more than anything else, given how global its supply chain is.
Nomi, I just want to summarize a few of the points you made. Overall, you don't sound too negative. You sound positive overall on the economy, on the S&P. You said the S&P is going to finish, you think it's going to finish higher than where it is right now. Let's just say 5,700 to 5,800. You're bullish on gold. You think it's going to move up toward $4,000 by the end of the year. I think you said if we go into a recession, it's not going to be a severe one. It's going to be mild. Do I have all that right?
Yeah, I mean, I would say on the economy again, what I want to just reiterate is we can see a technical recession. We can see an economic slowdown. We could certainly and are seeing hits to the consumer, given their debt overload and given the uncertainty that prevails. The market's a different animal from the economy, though, because the market functions on the basis of information coming in quickly and also the expectation that if the economy drags, the central bank is going to turn around and do something about it to minimize the cost of funding. So there's a dislocation between the economy and the market that I just want to verify. But yeah, other than that.
And if there was one element we didn't really discuss, maybe like a potential for a black swan event, what would it be?
Well, the banking sector really is the major black swan event, and it touches a lot of what we were talking about, whether it's housing, corporate uncertainty, the possibility that as a result, more workers will get laid off than are currently showing in the headline unemployment numbers. And what that all manifests into in terms of banking is that loans that are already extended, commercial loans, commercial real estate, office space, manufacturing space, whatever it might be, that have loans attached to them could default or could go into more delinquencies. Right now, the United States banking system is facing about $650 billion worth of what they call unrealized loans. And what that means is they're actually carrying loans on their books. They're just hoping they'll go away or they'll be restructured or they'll be pushed forward, but it'll all work out. That is a significant number that is higher than the number that went into the 2009 crisis. So any confluence of an extreme credit moment, let's say the entire auto sector can't, pay on its largest loans, or the entire semiconductor space, or whatever it might be, or even just more bankruptcies are seen. Maybe more McDonald's lose their footprint because traffic continues to go down. Maybe more, Rite Aids, like the drugstore that, is looking, flirting with bankruptcy and sort of, looking at that, closes more stores, and you start to see more vacant spaces, and therefore less money coming into the loans. I mean, all of these things that are in play, that are already happening, could result in more egregious bank failures. We have been really lucky since March of 2023, when we saw Silicon Valley Bank and it sort of fail at that point. We saw a collection of banks fail in the beginning of the year, Signature and so forth. We haven't really seen that in this newish period. But what we know is that there's a lot of bad debt, bad loans that are sitting on banks' books and accumulating. And that could be a black swan moment.
Yeah, a couple of comments on that. First of all, I was talking about the weakness in the Canadian economy earlier and also in Ontario. The central bank, Canada's central bank, has been very aggressive in cutting rates. We have short-term mortgages here in Canada. We can get a 3-year or 5-year. And so the central bank has been very aggressive in cutting rates because there's a number of mortgages coming up this year. In 2025, it's over 1 million mortgages. 2026, it's 1.2 million. And so, of course, everybody's going to have to refinance at a significantly higher rate. That's going to
Right,
be very onerous on
right.
expenses. And then when I hear you talking about what's happening with commercial real estate, we have a very large office complex in downtown Toronto. It's called Brookfield Place. It's 2 large office buildings. Prior to the pandemic, there was 12,000 people going to work there every day.
Mhm.
I just spoke to somebody recently who works for that organization, and they said it's only 6,000. So here we are 5 years after the fact, and there's still only half of the people going to work
Yeah.
on a daily basis, which just shocks me. But I wonder what the trickle down effect of all of that is,
Yeah, I
because
mean, it's less office space getting monetized, basically paying into loans that might be underlying that space. And you multiply that, whether it's across Canada, whether it's across the United States. Yes, part of it was still a post-COVID linger, but now we're also having economic uncertainty and tariff uncertainty and reduced consumer consumption coming into play as well. And that just sort of has the potential to make that worse. And none of those loans, it sounds like, in Canada, you might have more shorter term, lower in the yield curve loans. A lot of the commercial loans in the States are between 5 to 30 years, say on average like 10 years. So and that part of the curve really hasn't come down in rates, even with the 100 basis points cut last year to the short end.
well, Nomi, that was a great discussion as always, and I want to thank you very much for spending time with us today. And if somebody would like to follow you online or read some of your research, where can they go?
Thank you again. It's always a pleasure to speak with you, Jimmy. And I would ask that people, encourage people to check out printsites.substack.com. Printsites is behind me, where we do regular commentary on what's going on in the Fed, economy, and so forth. And then we also have premium and founders products where we really take deep dives into specific investments. Going out into the field, analyzing not just their books, but their facilities and what they're doing and what part of the economy they're doing it in. And all that can be checked out on printsites.substack.com.
Nomi, once again, thank you.
Thanks so much.